Okay, let's unpack this. Imagine a wager that really challenged, the core of Wall Street. Is true trading success an innate gift, something you're just born with, or can it actually be taught to anyone?
Right. A huge question.
Today, we're diving deep into the electrifying story of Richard Dennis, this legendary Chicago trader, and his famous experiment, the turtles.
It's a classic story, really.
Wall Street's conventional wisdom, it's often seen as this exclusive club, right?
Mhm.
Prestige, connections, not much room for the little guy.
Absolutely. And you had academic theories like the efficient market hypothesis.
Yeah, the idea that you basically can't consistently beat the market because all the information is already baked into the price.
Exactly. Which makes Dennis's belief even more radical. He was a total iconoclast.
He thought differently. So our mission today is to explore this experiment he ran and try to get at that million-dollar question. Are top traders born, or can they actually be made?
And it's fascinating because Dennis wasn't just, talking about it. He literally put his own money on the line. Millions.
Wow.
Which makes you think, if the academics say you can't beat the market, what kind of person even thinks they can prove them wrong, let alone teach others to do it?
Good point. What was his background?
Well, Dennis came from pretty humble beginnings, south side of Chicago, self-made guy. Turned a few $100 into hundreds of millions,
Incredible. All on his own.
all on his own terms.
Mm-hmm.
He understood, I think, that to get extraordinary results, you often have to step away from the herd, think differently.
Absolutely. A real wildcatting trader, they called him. By age 37, hundreds of millions from just a tiny starting stake, less than 15 years, no formal training.
And he took big risks. Apparently would bet everything on a trade sometimes.
And what's amazing is people say he understood behavioral finance stuff decades before it won Nobel Prizes, like how psychology messes with markets.
That's a critical point. It wasn't just about numbers for him. It was about human nature, too. And this led to this long-running debate he had with his partner, William Eckhart.
The nurture versus nature debate, right?
Exactly.
Yeah.
Dennis was firmly in the nurture camp. He thought trading was learnable, like mastering Monopoly or chess.
Just rules and probability.
Right. Understand the odds, execute with discipline, manage your risk. Not about some innate magic. Eckhart, though, he was skeptical, thought you needed that gut feeling, that intuition.
So how did Dennis decide to settle this bet? Because the way he did it was, well, it was pretty out there.
Completely unprecedented.
Yeah.
He took out these classified ads, cost him $15,000 back then, in '83 and '84. Wall Street Journal, Barron's,
What did the ad say?
Commodity Futures Trader,
Ah,
and the kicker. Experience optional.
experience optional to trade millions.
Can you imagine? Offering to teach proprietary trading secrets, the kind firms guard with their lives to total beginners. It just blew up the whole Wall Street recruitment model.
So he wasn't looking for the usual suspects.
Not at all. He deliberately avoided the typical recruitment channels. No focus on high IQs, fancy degrees, LSAT scores. None of that.
He wanted a mishmash, you said.
A real mishmash of personalities,
Mm.
as diverse as possible. The people he picked were, well, all over the map. High school grad, an MBA, sure, but also someone with a music degree, geology, linguistics.
An ex-actor, a blackjack player.
Yep, Air Force pilot, accountant, even a Dungeons & Dragons author. He picked one woman, which was rare then, and gay students too. He really didn't care about the usual boxes.
So if it wasn't the typical Wall Street pedigree, what was he looking for? What were the actual criteria?
Good question. He wanted people willing to take calculated risks. People who didn't just follow the crowd. People who enjoyed games of chance maybe, and could think in probabilities and odds.
Like playing Risk, the board game.
That kind of mindset, yeah. The application itself is pretty weird, too. True-false questions designed to trip you up. Things like, trends are not likely to persist, or it's good to average down.
Trying to see their gut instincts, maybe?
Or their biases. NSA questions. Favorite book, riskiest thing you've ever done. One guy drove around Saudi Arabia with whiskey. Another drove an hour to a game with no ticket. Just trying to gauge risk appetite and independent thinking.
And the Rommel guy.
Right. Mike Carr cited Field Marshal Rommel. Dennis liked that strategic thinking. They even had this elevator filter. A casual wrong comment could get you cut.
Intense.
The goal was to find tabula rasa, blank slates, people without bad habits to unlearn.
Okay, so he finds his blank slates. Then what? 2 weeks of training? How on earth do you teach someone to trade millions in just 2 weeks?
It was incredibly intense, no doubt. But yeah, 2 weeks to learn everything they needed: bonds, currencies, corn, oil, stocks, the works.
And they got Dennis's actual money to trade.
$1 million each. But it wasn't charity, as Dennis said. The deal was 15% of profits for the student, 85% for Dennis. High stakes right from the start.
Kept them focused, I bet. What was the core philosophy he drilled into them?
It was all based on the scientific method.
Yeah.
Seriously, define questions, form hypotheses, experiment, analyze data, conclude. He told them, think of yourselves as scientists first, traders second.
Wow, that's very different from the usual get-rich-quick trading advice or just focusing on company fundamentals.
Completely different. Dennis had this saying, price is the reality and intelligence is the appearance. He famously said about soybeans, if it's raining on those soybeans, all that means to me is I should bring an umbrella.
He didn't care about the news, just the price action.
Exactly. Purely objective, data-driven.
Okay, that's a really detached approach. But how do you build a system that forces people to go against their basic instincts? The urge to buy low and sell high.
That's the absolute crux of it. Dennis figured out that successful trading often means fighting your own human nature. The turtle rules weren't just strategies. They were like counter-psychology.
Forcing them to do what feels wrong.
Pretty much. They were taught trend following. Wait for a market to make a move, then jump on board. Buy strength, sell weakness.
So buy rallies and sell breakdowns, doing the opposite of conventional wisdom.
Exactly. They use breakouts for entry signals. Like if a market hits a new 55-day high, that's a buy signal. Time to get in.
And they had specific systems for this.
Two main ones. System 1, or S1, used a 4-week high-low for entry and a 2-week high-low for exit. System 2, S2, was slower. 11-week entry, 4-week exit, gave them different ways to catch trends.
Okay, strategy makes sense, even if it's counterintuitive. But where does risk fit in? Trading millions must involve huge risk.
Risk management was everything. It was built around this concept called N, which stands for average true range.
Right, a measure of volatility, how much a market typically moves each day.
Precisely. And N was used for everything risk-related, especially position sizing. They tied the amount they traded directly to their account size, usually risking only about 2% on any single trade.
So N dictated how many contracts they could buy or sell.
Yes. For example, if corn had an N of 7 cents, the dollar risk was $350 per contract. They used a 2N stop, meaning they'd risk $700 per contract on that trade. N determined the bet size based on volatility.
So the 2N stop was the eject button.
Absolutely crucial. If the market moved against them by twice the N value from their entry, they were out. Period. No thinking, no hoping, just exit. Discipline was key.
And they also added to winners, pyramiding.
They did, adding to positions that were working usually at intervals of N to really capitalize when a strong trend took hold.
Makes sense. But what about the inevitable losses? How are they taught to handle those? That must be psychologically brutal.
It is. Dennis was blunt. The trader who is averse to losses is in the wrong business. Rule number 1, never average down on a loser. Don't throw good money after bad.
Like Paul Tudor Jones take lots of small losses for one big win.
That's the idea. And it required what they called memoryless trading. Your decisions today are based only on your capital today. Forget where you bought it. Forget past wins or losses.
The John and Mary example.
Right. If John and Mary have the same capital now, they should make the exact same trading decisions now, regardless of their past performance or starting capital. It's all about the present odds.
He wanted them to be like the casino house.
Exactly. Except lots of small losses, knowing that the big wins, driven by the system's edge, will eventually outweigh them. Consistency was vital. A small tweak to the system shouldn't blow it up. It needed to be robust.
Wow. Okay, so you've got these newly minted trader scientists armed with these counterintuitive rules, funded with millions. What happened when they actually started trading? Was it instant success?
Not exactly. That initial period, the womb, as some called it, was interesting. They were in an office, not much direct supervision, lots of downtime apparently, ping pong tables.
Sounds kind of relaxed for million-dollar trading.
The routine was mundane. Check printouts from the floor, call in orders if the system triggered, wait. Almost like being monks, just focused on executing the rules.
But you mentioned it wasn't an immediate success story.
Far from it. And this is maybe the hardest part. Imagine you're a turtle. You've learned the rules, you're funded, you're doing exactly what you were taught.
And your account is just shrinking.
Exactly. The first group, 6 months in, they were down an average of 50%. 50.
Oh my God. That's brutal. Sticking to the system then must have taken unbelievable discipline, or sheer terror, maybe.
It really highlights the psychological side, doesn't it? Knowing the rules is one thing. Executing them when you're losing big money is another beast entirely.
And Dennis himself wasn't immune to struggles later on.
No, he faced his own challenges, dealing with client expectations when managing his own fund, which can conflict with pure system trading. He had some big personal trading losses, too, like $14 million in silver at one point.
So even the guy who invented the system found it hard to follow sometimes.
It seems that way. He knew enough to teach his students, but maybe found disciplining himself harder later on. It shows how tough it is.
And were there issues within the Turtle group itself? Controversies?
Oh, yeah. A major one was unequal money allocation. Dennis apparently gave some turtles, like Curtis Faith, much larger accounts to trade than others, even if their performance was similar.
That would definitely breed resentment.
Caused jealousy, destabilized things. One guy, Jim DiMaria, apparently got a $10K bonus, while others made hundreds of thousands. And Faith was seen as a favorite, getting personal guidance from Dennis, especially on a big heating oil trade.
How did Faith do?
Made huge money, like $31.5 million from the program. Though, interestingly, he also admitted later to losing $14 million himself at one point.
Volatile stuff. And someone tried to sell the secrets?
Right. Russell Sands, one of the original turtles, started selling the rules for about $2,500.
Gosh.
Caused outrage among the others. Jerry Parker famously said it was nothing worth $2,500.
Implying the rules themselves weren't the real magic.
Perhaps that the real value was in the discipline, the mindset, the whole experience, not just a list of rules you could buy.
So, despite the controversies, the experiment clearly had a legacy. If we look long-term, after the program ended, what did we learn from the turtles who did succeed?
Well, stepping back, the experiment did prove Dennis's point, at least partially. Nurture could teach the mechanics, but the longer view, the second act, showed something deeper about sustained success.
Like Jerry Parker. He became the most successful.
By far. Last estimates had him managing around $770 million. And his setup was interesting, unassuming office in Virginia, not some Wall Street skyscraper. Location didn't matter.
What did Parker learn from Dennis that helped him last?
He said the big thing was Dennis giving him confidence, making it okay to lose money as part of the process. But Parker adapted. He lowered the leverage, aimed for steadier 15–20% annual returns, not the wild swings Dennis initially aimed for.
Smart. Appealing to big institutional investors.
Exactly. He realized if you're going to raise a lot of money, people would be very happy with 15% or 20%. And crucially, he built a business around the trading. Hiring, accounting, legal, marketing, the whole package.
So it wasn't just the trading rules.
No, it was business acumen, plus, as he put it, faith in God and your system.
Powerful combo. Any other big success stories? Maybe people who weren't even original turtles?
Absolutely. Look at Salem Abraham, called a second-generation turtle. Never met Dennis, learned the method from Jerry Parker at a wedding.
No kidding.
Started with $30,000 from his grandfather in tiny Canadian Texas population, 2,300, and built it into millions. His experience later reinforced Eckhart's focus on pure math and data.
Love the story about him being denied a rental car.
Right. Managing $15 million at age 25, but too young to rent a car. Shows the disconnect sometimes.
So, bringing it back to the core question, nurture versus nature, what's the final verdict after all this?
Well, Eckhart, the original skeptic, eventually conceded. He said the answer to the question of whether trading can be taught has to be an unqualified yes. So Dennis won the bet, technically.
But there's a but, isn't there?
There is. As Larry Haight, who founded Man Group, pointed out, Dennis didn't necessarily select for or train things like mental toughness or that relentless drive to win.
Things you might argue are more innate.
Or at least harder to teach. It highlights that raw talent, even if it exists, isn't enough. Think of sports drafts. Top picks fail all the time. You need that deliberate practice, that resilience, like Charlie Munger or Eddie Lampert show in their fields.
So you need the system and the mindset.
Precisely. And the market itself, it's the great equalizer, isn't it?
Yeah.
It doesn't care who you are, your background, gender, race, nothing. It's still this frontier where if you've got the cash and the guts and the right approach, you can take your shot.
Okay, so wrapping this up, what does this whole incredible turtle story mean for you listening right now?
Good question. What's the takeaway?
I think the core lesson is pretty profound. Dennis's experiment, yeah, it proved the mechanics can be taught. The systems, the risk rules, how to enter, how to exit, that's learnable knowledge.
Definitely. He proved that part.
But the long-term sustained success, the Jerry Parkers of the world, that seems to hinge on something more, something maybe harder to teach.
Right. It's more than just the rules on paper.
It's that relentless pursuit, isn't it? The discipline to actually follow the rules day in, day out, especially when your gut is screaming, no, don't do that.
And sticking with it during those huge drawdowns, that takes serious optimism, serious belief.
That ability to just roll with the punches and keep playing the game. The turtles teach us, I think, that having the system, having the information, that's powerful, sure, but it gets amplified massively by that unshakable belief in your process, maybe that inner entrepreneurial fire.
It's not enough to be given the map.
You've got to actually walk the path, right? Through the tough parts.
Which brings up a final thought, maybe. In today's world, we're drowning in information, right?
Yeah.
Rules for success, secrets, hacks, they're everywhere.
For everything, not just trading.
Exactly. But how often do we mistake knowing those rules for having the actual courage and the resilience to really play the game, to execute when it counts?
That's a great question. The knowing versus doing gap.
The turtle story is about that interplay, method and mindset. You need both. And the cool thing is the opportunity to figure it out, like Sale and Abraham did, it's always there.
For those willing to really commit.
And, for those with that drive, the game never really ends. Richard Sandor, the finance legend, confirmed it with a smile back in 2006.
What did he say?
You do know that Richard Dennis is trading again.